So in this question, we have Aspen Company. Ultimately, we're focused on sales tax. Now, we need to understand how sales tax is treated by a company, right? So when you go and purchase something from a company and you pay sales tax, that is not money that they get to keep, right? Ultimately, they collect the sales tax in cash from you, but then they have to remit it to the government, right? The government wants their sales tax money. And so basically, sales tax for a company, when they collect it from you, there's only a balance sheet impact, right? You will not see anything regarding sales tax collected from customers in a company's income statement. So when they collect cash from you for sales tax, it's a liability on their balance sheet until the company remits the sales tax to the government, right? So basically what we need to do here is calculate the total amount of sales tax collected and then factor in the amount remitted to the government, right? And that will help us determine basically the ending balance for sales tax payable in the company's financial statements, right? So in our first step, we'll calculate the amount of sales tax collected during the year. And that's just going to be net sales of $800,000 times the sales tax rate of 5%. And that means they would have collected sales tax of $40,000 from customers, right? Now, ultimately, that will need to be remitted, but that doesn't always line up with its collected, right? So now we can prepare a sales tax payable roll forward to figure out what the ending sales tax payable balance would be at the end of the year. So we need to think about what increases sales tax and what decreases it, right? So our beginning balance, which is sales tax payable $4,500, that's our starting point. We always start with the beginning balance. And then sales tax collected, that's what increases the liability, right? The company now has the cash, but it's not theirs. They must remit it, which will increase the liability here. And that was from step one of $40,000. Now, when they actually pay the sales tax in cash to the state authorities or the government, right, that will decrease the liability because the cash is no longer on their balance sheet, right? It says that sales tax remitted during the year was $39,500. Well, that means our ending sales tax payable balance is going to be $5,000, and that's what would be reflected in the current year financial statements, right? So $5,000 in sales tax payable is the correct answer. Now, real quick on the incorrect options. Well, sales tax never results in revenue, right? So that's why $40,000 in sales tax revenue is incorrect. Remember, there is no income statement impact. Same thing with the next line that says $39,500 in sales tax expense. It's not an expense for the company when they collect sales tax. Now, if they have to pay sales tax when they buy something from somebody else, well, there could be sales tax for that, but that's not sales tax they collected, right? That's sales tax they paid. And then on the last one, again, it relates to revenue. Sales tax does not result in revenue, right? So that's why those options are incorrect.